And meanwhile, I'm afraid no sort of ease up in the pain that we're seeing in US pending home sales, falling for, well, actually the second lowest level on record, negative 4%. Previous to that was the record low of negative 4.6% that we're seeing in pending home sales. And the market had been expecting just a slowdown of some 1%. Now, overall, we are seeing the continuing contractions in the housing market. We know why. Interest rates going up, mortgage rates therefore going up, more expensive to be buying your homes. But really, this is the sixth straight month. And remember, this is a November number, so it is quite backward looking, but it's the sixth straight month that US pending home sales have indeed fallen. And we've got a great guest to dig into really where the housing market's going overall, Paul, because one Rich Hill is with us. We're pleased to welcome, of course. He is head of real estate strategy and research, Cohen and Steers. Rich, once again, moon music on manufacturing actually looking a little bit better, it would seem, for the data, but the housing data, once again, really painful. Where are we in the cycle?
Yeah, sure. Look, this was an undeniably challenging year for real estate investment trusts known as REITs. They were down around 25% through the close of business at the end of last week. Inflation is usually pretty good for real estate, but what is challenging for real estate is stagflation. So what is stagflation? It's an environment where interest rates are rising and growth is slowing. That's exactly what played out for most of 2022, where the Fed had to raise interest rates to combat inflation that was at its highest level since 1980. So it was really a backdrop of higher interest rates, widening credit spread, and slowing growth that has pressured the real estate backdrop.
So, Rich, I mean, there's folks out there that watch the Fed thinks that, 2023, we're going to see a peak in rates, and we, in fact, may even see some rates come down toward the back half of the year. What's the REIT outlook for 2023 after what was, as you just mentioned, was a really challenging 2022?
Yeah, sure. Look, we believe that there is potential for low double-digit returns in the year ahead. That's pretty good compared to the negative 25% that we had so far this year. What is driving that view? I think there's really three things that we would point out. First of all, growth will undeniably slow in our view, given recessionary pressures, but it will be well above trend versus prior recessionary environments. So that's point number one. Point number two is that we actually do see a better inflationary backdrop. I mentioned that stagflation, where interest rates are rising and growth is slowing, is really challenging for real estate. But we see a backdrop where growth is slowing still in 2023, but rates are beginning to come down. So we would call that a stagnationary backdrop. As you transition from stagflation to stagnation, that's a much better backdrop for real estate in general. And the third point I would make is that when the Fed stops raising interest rates, and that will likely occur at some point over the next, call it 12 to 18 months, REITs usually do very well. So to summarize all of that, we think growth is on solid footing. It will slow, but it's still on solid footing. We think a backdrop of transitioning from stagflation to stagnation is really good for real estate. And number three, as the Fed stops raising interest rates, that's historically an environment where REITs produce plus 16% returns historically 6 months after the Fed stops raising interest rates. So altogether, we see a better backdrop.
Rich, not all real estate is created equal, as I know you know more than anyone, of course, with your focus on REITs. We were breaking, of course, the pending home sales. We were talking about a consumer, about where one wants to live. But from your perspective, talk to us about the most appetizing parts of the markets that are going to be recovering, the bits that you're still not tempted to be going into at the moment.
Yeah, sure. So what are the sectors of the market that we do like? We like multifamily, particularly in the Sun Belt. We like single-family rental. I think your point about what's happening to the housing market really speaks to the strength of the single-family rental market. It's buying homes is really unaffordable right now, but if you can sort of rent the American dream, so to speak, through single-family rentals, we think that's compelling. Population migrations to the Sun Belt are continuing to support multifamily trends. Again, if you can't buy a home, you have to live somewhere. We do like data centers. And we like healthcare as well. On the other end of the spectrum, maybe sectors that we're a little bit more cautious on, I would say first and foremost the office sector. Maybe that doesn't come as too much of a surprise from anyone, but as we figure out work from home trends and other trends, it is still a sector that's pressured. And then hotels we're a little bit more cautious on as well.
So Rich, Caroline and I, we are ensconced here in Bloomberg's headquarters in Midtown Manhattan. And as we look around,
offices here.
Yes, in the offices, thank you. And as we look around, we see a lot of empty office buildings in Midtown Manhattan. If I'm an office REIT manager, what do I do? I mean, it's not just New York, it's San Francisco, it's other major markets. Is there a solution?
Yeah. So let me make a couple comments first and foremost. I think we paint office with maybe too broad of a brush. New, clean, and green office, we think is very well positioned, and I think you can probably look outside your headquarters and see that some of the newer buildings are doing quite well. We think call it suburban office is well positioned, particularly in the Sun Belt. But where there's really much more of a challenge is Class B and C office properties. Those were properties that were built in the 1970s or the 1980s, and there hasn't been a lot of money put into them. So what do you have to do? Well, you have to find a way to reposition them, redevelop them. There's not an easy one-fit-all solution. We've started to see some trends of redeveloping them into multifamily properties, but I think it's going to take a little bit of a combination for entrepreneurs coming in, existing owners working together to find a solution. The easiest one that people are talking about is redeveloping them into multifamily.
That's super hard, though, right? Like that's not easy.
Very, very, very hard. The good news is the land underneath most of these properties, particularly in New York City, San Francisco, is pretty valuable. So I do think we'll find a solution, but it's really a question of where's the net operating income growth going? How much CapEx do you have to spend? And that's why the sector continues to be under pressure.
Rich, I find it interesting also, you didn't just mention offices that we've prided you with, but also the hotel sector. Why are you worried about the hotel sector?
Yeah, look, I think the easy solution is that maybe travel is coming down from peak levels that we saw in 2021, 2022. Yes, business travel is coming back up, but one of the major issues that I don't think a lot of people maybe unpack enough is how much labor costs are rising. And to run a hotel, it does require a lot of labor. And so that's one of the things that keeps us maybe a little bit more on the sidelines. Growth is beginning to slow. That's pressuring revenue at a time that expenses and labor costs are going up.
Hey, Rich, as I drive down to the Jersey Shore on the Parkway or the Turnpike, I see tons and tons of, just kind of
high barriers to entry, infill locations. Yeah. And I think investors should be aware that maybe some of the older properties and not well-positioned markets with high supply, those could face some growth challenges.
Rich, I'm looking at your, $84 billion firm-wide assets under management. That's not just US, is it? Because we're a global network. We've got European audience with us at the moment, as well as, well, maybe some Asian viewers staying up pretty late. Talk to us about where you're thinking globally is attractive in REITs.
Yeah. Well, look, I would say we think the best opportunities are certainly in the United States right now. But as you start to think about other opportunities, whether it be in some of the Chinese locations that are beginning to open up, I think that's interesting. Some of the major markets in Europe are interesting. But I think we do see the best value in the United States right now.
Hey, Rich, let's say I'm an entrepreneur in the real estate business. I want to go buy one of those empty office towers in Midtown Manhattan. Where do I get the money? Do I go over to JP Morgan and borrow some money?
Yeah. So you're asking a really interesting question. The debt markets are, I would say, not frozen by any means, but they're not wide open. I do think there is debt capital available for a high quality property with a good sponsor. But there's also a tremendous amount of money on the sidelines that's been raised and not yet deployed in commercial real estate. Around $300 billion. Maybe that's about call it $900 billion, $1 trillion of buying power once you put some leverage on it. So the debt markets are there. They're not wide open. The easy money's been gone. But I think it's a combination of finding cheap debt capital where you can find it, and cheap is all on a relative basis at this point, plus some additional equity from the amount of money on the sidelines. So I think lenders are being much more selective right now than they have been in the past. They're being very focused on what property types they lend to, but more importantly, making sure that the sponsor is well capitalized.